Welcome everybody to the second installment of Rotchford Associates presents 5-minute financial lessons. Part 1, we talked about the difference between tax codes, pre and post tax meant for retirement. Now we're going to talk about retirement options offered through your employers. Pensions are something offered by most companies long ago. They didn't have the turnover rates that a lot of people in careers now have. So you would work for a company for 20, 30, 40 years, you get a gold watch, and you get a pension. And pension is lifetime income. So you served the company well for all those years, and now you're going to reap those benefits. They're very rare now because they're very expensive for companies and their liabilities. So it used to be used a lot with blue chip companies. Typically now you're only going to find them in state and federal work. But they were lifetime income. They were wonderful in theory. The problem is if companies go under, so do these pensions. Now, there is a federally funded pension benefit guarantee corporation which will take over companies' pensions. There's some limitations to it, but they are, again, federally funded, which is 27 trillion in debt, and so, but also they're running at a deficit currently as well. So who knows how long that can keep going on. So pensions are great as long as they can keep funding. Because they're so expensive to fund from companies. Now there's another option, which is what you're probably all more used to, which is the 401k. So why are 401ks a much cheaper option? Well, a lot of it you fund yourself. So you put in money and then a company will match. At least typically they used to match. That's actually going away quite a bit in 2020. 401ks are still being offered, but the employers are taking away their match so they could stay a little bit more profitable during these uncertain times, which is kind of a terrifying concept because as a country we're already not saving enough for retirement, and this is taking away one more vehicle of that. So 401ks, if you have one, I'm sure you've seen a lot of them have 10, 20, 30 options for you. By law they're required to have a minimum of 3. They have to be diversified. But the big one that I want you guys to know about is that there's always a safe bucket. There's typically a money market or a stable value fund. So a con to what 401ks are, it's strictly in securities. So it means stocks, bonds, mutual funds, ETFs, that sort of thing. But there could be market volatility. In 2008, people with 401ks lost 30 or 40% depending on how they were allocated. The same goes for March of 2020. The market dropped 30%, so 401ks were hit. So if you want to not be, say you're close to retirement and you don't want to deal with this market volatility, you can always move your money into this safer bucket. So that's an option that not a lot of people knew they had. 401ks are good too. You can take out loans from them, either hardship. Some of them offer non-hardship withdrawals. The cons, it's all money at risk through the stock market. And the biggest con, though, is it's not lifetime income. It's not a pension. What you have at the end in your 401k is all you've got. However, you can fund pensions on your own. So I'll get into that. Building your own pension. Now this is something that you can do with IRA money, Roth money. You can use money from your bank. How you do it's offered through insurance companies and has the ability to stay safe from market volatility. And I say the ability to stay safe because there's different types of annuities, but I'm going to get into that in a second. Can be turned on for lifetime income, just like a pension. If you do have a pension at your employer, look at the paperwork. All of it on there is going to have one word on there, and that word is annuity. If you win the lottery and you get payouts for life, that's an annuity. Social Security is an annuity. Pension plans through employers, these are annuities. Now, depending on who you hear from in the financial world, you're going to hear good and bad things about annuities. And the problem with that none of them really disclose, is that annuity is a blanket term. There are a lot of different types of annuities, but the two main differences are fixed and variable. So there's 4 main types in general of annuities. The first 3 I'm going to name are fixed. Fixed means that they can only go up They do not go down compared to what the stock market is doing. The first type is a SPIA. It's a single premium immediate annuity. Basically, you give the insurance company a lump sum of money. They decide based on death rates that they think you're going to live until you're 85. So they're going to give you all of your money back plus interest until you're 85. Now, this is lifetime income. If you live to 95 or 105, you're going to keep getting those payments for life. Next is a MIGA, multi-year guaranteed annuity. This works just like a bank CD. It's a set term, set amount of interest, which is typically significantly more than the banks are offering you. Also, it's tax deferred. It doesn't matter what tax code you use to fund your annuity, IRA, Roth, non-qualified. The annuities themselves are tax deferred vehicles, so you get that tax deferral bonus through. The MIGA can be turned on too, typically after year one, to pay out for life. The next option is a fixed index annuity. These ones are some of our favorite. Now these ones aren't sensitive to the market, but you can do something that's kind of market adjacent. Basically, you can allocate your money to an S&P 500 option. If the S&P 500 goes up 10%, you don't get full 10% because this is a fixed annuity. It can never go down. So you get a fraction of that. You get, I don't know, 3 to 4%. So you get limited upside. However, if the S&P 500 goes down 10%, the worst you can do is earn 0 interest. So you have no downside with this, limited upside because they can't give you all of the upside while taking away the downside, right? There's no, if it sounds too good to be true, it is. So of course there's some pros and cons to that, but upside is there with 0 downside potential as far as the market is concerned. Now the next main type is a variable annuity. So what variable annuities do, variable annuities are market sensitive. So not only are they market sensitive, but there's a lot of fees associated too. So they're expensive, they're market sensitive. Overall, we don't like them. We don't offer them in our office. But it's something that people need to know about. And a lot of times when people like Ken Fisher are talking about how terrible annuities are, typically they're talking about variable annuities. But they never disclose that. They just say annuities as a blanket term are bad for you. So, well, I appreciate you guys watching it if you have made it this far. If you have any questions, concerns, comments, feel free to reach out to us. We are a fully independent 4th generation family office. It's me and my stepdad, J.R. Rotchford. So we'll be happy to help any way we can. Cheers, guys.